to the Savvy Woman Proactive Wealth Education Series. I'm Cathy Brentlinger, a certified financial planner with Savvy Woman Wealth Management, where we're dedicated to financial education for women. At Savvy Woman Wealth Management, we provide education events, live events, and webinars about financial related topics, and we work with different financial specialists to help us educate our clients. We've heard from our clients and you who asked us to provide additional topics on asset management, liability management, protective strategies, and estate planning. I get client calls all the time from clients about, should I get solar? Should I buy or lease a car? Should I get a mortgage? Should I refi? And so we believe in collaborating with other specialists, and today we have with us a veteran mortgage specialist, Cathy Brentlinger, who's also a branch manager with Fairway Independent Mortgage Corporation. Welcome, Cathy.
Thank you. I so appreciate the opportunity to discuss financing. It's a topic that's coming up a lot right now because in the current mortgage world, we're seeing interest rates rise, and so it's making the affordability a little bit more challenging than it used to be. It's also making it a little bit more difficult for our clients to be able to shop an apples to apples. So if they're doing a comparative search for the best financing options for them, it's really important to understand the aspect about points. And basically when we talk about mortgages, you always have several different options, and you have to kind of take a look at the balance between the amount that you're investing in terms of closing costs and the comfort level you have with a monthly payment. So again, as interest rates have moved up, we found that some of our clients are looking for ways to be able to lower their monthly payment over time. So an obligation of 30 years.
Well, it's interesting because that comes up for cash flow. So some people, if they're retired or they're looking at their monthly expenses, they want to look at what's coming in and what's going out. So that's definitely probably something timely in considering when they look at their mortgages.
Exactly. Very, very good point. So the other aspect of it is that occasionally that difference in interest rate is the determining factor as far as how much people qualify for a loan. So if somebody falls in love with a house and they're kind of pushing the upper limits of what they're qualifying for, we're able to look at points as a means of dropping the interest rate for the entire life of the loan in exchange for an upfront investment in order that they might secure a lower monthly payment. The other piece of the equation when it comes to the points is as you're shopping for mortgages, it's something to be aware of because oftentimes it's not disclosed as far as rate. So when you shop, typically the first thing you'll ask as a consumer is, gosh, what's your rate? And all of a sudden somebody says, oh, I have this fabulous rate. I'm going to offer you a rate of 4%. Well, that sounds phenomenal. The second question needs to be, okay, what is the cost associated with that rate? And that's where the points come in. So points are a percentage of a loan amount paid up front at closing in order to secure a lower rate and a lower monthly payment over the life of the loan. So essentially what you can look at it as is prepaying a lump sum of interest at the front end of your loan, almost like front loading it by paying prepaid interest at closing, so that over the next 30 years, you're going to experience the benefit of that lower interest rate.
And so do you think it's important to look at that when you are considering a mortgage, looking at both options? Is that something?
I think it's really important, and it's important from the perspective of what's your long-term plan. Mm-hmm. So what we usually look at is what is the cost associated with a point, for instance, which let's assume, in this case, the scenario we're using, we looked at a $800,000 purchase price and a $660,000 loan amount, a 20% down payment. So 1 point is a cost of $6,600. Not insignificant. And typically it's usually about a 5 to 6 year break even relative to what you've invested up front versus the difference in monthly payment.
So if somebody then thinks they're going to move in the next 5 or 10 years, and probably not something.
Exactly. Unless there were a specific reason, there are other things that go into that decision relative to, because it is an upfront amount of interest paid. Sometimes there's some tax benefits to it. So depending upon how long you've owned a home, if you're buying toward the end of the year and you haven't had the benefit of interest deduction throughout the year, occasionally a financial advisor or a CPA will advise, go ahead and pay the points, because it's not a dollar for dollar. We're going to get some tax benefit from that. And so consequently, it's maybe less than a 5-year break even. So it's really important to look at it in the overall scheme of things. The other piece to kind of bear in mind is that as we're seeing a bit of a transition, at least here in California, relative to the real estate market, things are transitioning from the point of a perspective of property staying on the market a bit longer. And it's allowed the opportunity for a lot of our buyers to be able to negotiate the seller paying closing costs for them. So clearly, if a seller is willing to help you to buy down an interest rate over the life of the loan, you still have the benefit of the tax deductibility, even though you're not actually paid it.
That sounds like a great tool.
Isn't it?
Yeah, I like that.
And so at that point, there's really not a downside to it because you're experiencing the long-term benefit of having paid that point, and you're not necessarily paying it out of your funds.
So then would that happen through escrow, or is that when that would
That's correct. Yep. So if you negotiate and you talk to your realtor and they say, hey, this house has been on the market a while, let's see if they wouldn't be willing to supplement your closing costs, and maybe we can negotiate enough so that they pay a half a point or a point, and then you have the benefit of the long-term savings as long as you live in the house without necessarily the entire weight of the cost or the upfront investment.
Great.
So that's a strategy that's been very helpful. And as you're shopping for mortgages, where the points become very significant again, is that sometimes we find that it's not being very clearly disclosed. So when you go shopping for a rate, make sure that you're looking not just at that rate, but also what is your initial upfront investment or points associated with securing that rate. Although the rate sounds low, if your upfront investment is a lot, and you're not planning to be in the house over a long period of time, it may not be the best option for you. So that's just something to consider as well.
Great. Well, thank you very much. I know there's a lot of moving parts when it comes to mortgages, but definitely something that we wanted to clarify is the points versus no points. Is there anything else that you want to address regarding that? And you feel like you...
I think, unless there's something specific you could think
No,
of.
I think just anything in general with interest rates and any comments before we move on.
So interest rates always a great thing, probably similar to your business.
Yeah.
Really hard to have that crystal ball, right? That being said, what we have found is that it would appear, just of late, we've actually seen interest rates come down a bit. And I believe that has a lot to do with the fact that the Fed has kind of put the brakes on some of the short-term increases. And although that doesn't directly impact mortgage rates, when people see the benefit of maybe their credit card rates and their car rates staying lower, it gives them more affordability. They have some confidence in the economy, and that generally translates into rates staying low. So we're hopeful that they'll certainly stay where they are.
So I thought I'd take a few minutes and talk about how liability management ties into the financial planning process. So when you look at financial planning, it's basically creating a life where we look at what are your priorities, what are your goals, and through that, we look at your investments, your home, which is a big portion of a lot of people's assets, the liabilities like we talked about today. We often looked at, should I refinance and where are rates, which is important, and especially if rates are going up or down. And so in addition to that, we look at Social Security, we look at cash flow, what income do you have coming in, what are your expenses, factor in taxes. And so when you look at your whole financial plan, it's not just investing, it's looking at everything, because there are some debts that you may have that you may want to consider and evaluate. And so it is looking at everything through the financial planning process, and liabilities management is definitely a key part of that. So hopefully you learned something from us today. I'd like for you to go ahead and share with our listeners how we can get in contact with you.
I appreciate that. So again, Cathy Brentlinger. My phone number is area code 760-473-0109. That's the best way to reach me. And you can actually look me up online. You can check out my ratings, and always happy to address any questions. I really like to help people to be very educated in the process and to make sure they can make an informed decision. So again, 760-473-0109. Thank you.
And if you'd like to reach us at Savvy Women Wealth Management, I can be reached at 760-692-5700, or you can check out our website at savvyup.com. That's savvyup.com. We're happy you were here to join us today and that you're getting savvy about your finances. And remember, knowledge is power. For successful investing, never stop learning, and savvy up.